Hi, I'm Kevin Nunez, investor, entrepreneur, and professor. I grew up in a part of New York City where nobody was talking about saving or investing. We were in survival mode. I earned my bachelor's degree from Fordham University and an MBA from Cornell University. I worked my way up Wall Street firms like Morgan Stanley and Merrill Lynch. I did everything you're supposed to do. And I could have kept climbing that ladder, but I chose something different. I chose to build. I chose to teach. I chose to invest in our communities because too many families are often fed bad information about money and it costs them generations. So this is Invested in Us, where we break down money, markets, and ownership so our communities can build real wealth and real legacy. Hey everybody, my name is Kevin Nunez, founder of NJK Partners, and welcome back to another episode of Invested in Us, where we explain money how it should have been explained to us. Alright friends, so in terms of the state of capital, the volatility continues. Last week, all three major indexes posted their fourth straight weekly loss, and man, it's rough out there. So the Russell 2000 and the NASDAQ closed in bear territories when compared to their 52-week high, meaning they're down over 10%, over the last 52 weeks. So, it's a difficult market out there. And this is why I'm a big fan of just planning for the long term, because you cannot control, the markets are honestly trading on headlines right now. They're not even trading on fundamentals, on, valuations and cash flow and stuff like that. It's mostly just vibes, unfortunately, and it's just basically just headline after headline based off of what's happening in the Middle East. Are the Straits of Hormuz open or closed? Are there peace talks as of this morning, or they're not? We're getting conflicting information from both governments, so this is leading to a lot of market volatility. Now, it's incredibly important to remain calm because underneath the hood, the fundamentals are still strong. Companies are still reporting profits. Many companies are still optimistic on their profitability, meaning that likely, if that falls through and these companies remain profitable, likely their stock prices will go up. So, there's a lot of reason to remain optimistic. And frankly, American stock markets have a pretty good track record of bouncing back from some pretty wild news. I mean, if you think about the last 6 or 7 years, you've had COVID, you've had high inflation, then you had supply chain shocks, then you had interest rates, then you had, tariffs, and now you have war, and there's just so much volatility, and still the reality is, most U.S. stock markets are still not too far off from their all-time highs. So it's important to just remain calm, understand the risk that you're taking, make sure that's in line with your time horizon, right? Because you don't want, if this bucket of money is not needed for 20 years, you don't want to take 1 year risk in that bucket of money. But if I have a bucket of money where I need that money in 1 year, I don't want to take the type of risk that I wouldn't take, that I would normally take in a 20-year bucket. That's a huge misalignment. So you want to plan accordingly. So friends, the S&P 500 down as of last week. The NASDAQ down, the Russell 2000 down. All these indexes are down. Like, it's really, really hard to, make money in this environment. Despite, the energy markets are all up. We were watching the S&P energy sector up. You were watching midstream energy, companies up on the year. So when you think about the energy markets, I like to break them down into three different categories. You have upstream companies. Those are companies that are basically digging gigantic holes in the ground, extracting oil. Then you have midstream companies. The midstream companies are the companies that transport and these are pipeline companies and stuff. That's more of a logistics play. That's more of an infrastructure around the commodities play. And then you have downstream, and the downstream are like the refineries and the gas stations and stuff like that. So when you think about the energy markets, break them down into three: upstream, midstream, and downstream. And pretty much all three sectors are doing well. The energy subsector of the S&P 500 is up over 30% year to date as of last Friday. These are pretty incredible numbers. Midstream energy in the United States of America have been on fire for the better part of this decade, and there's no reason to believe that that's going to slow down. Many of those and I like the midstream companies specifically, and I like that sector specifically. And granted, there's a little bias here because of my last lifetime. I was an energy analyst at Morgan Stanley. But those midstream companies, they have strong balance sheets. These companies are really, really profitable, and there's high barriers to entry, so there's minimal competition. So these companies have been essentially printing money for the last couple years, and there's no reason to believe that trend is likely going to slow down. For the most part, in all three sectors of energy, whether it's upstream, midstream, or downstream, these companies were bleeding money into all these very capital intensive projects over the last couple decades, and that really didn't result in much profitability. So over the last couple years, you've seen a lot of those CEOs and management companies shift their business model to having better, stronger financials, having better, financial health for the company, which means, toning down on the spending, what we call CapEx, right? We're toning down the CapEx in terms of like billion-dollar equipment and stuff like that, focusing on cash flow and profitabilities, and most importantly, returning, some of that cash flow back to the stockholders in the form of either dividends and or distributions. So when I think about risk in the energy markets, the upstream companies are the riskiest, right? Just like in real estate, because those are the companies that are essentially digging gigantic holes in the ground, trying to extract these, resources. Then the midstream companies, that's a slightly safer play, because again, that's more of a play on the infrastructure. These are companies that transport, and these are like pipeline companies and stuff like that. And then you got the refineries, and those are essentially the processors, the gas stations, and things like that. So make sure, if you're thinking about investing in the energy markets, although I think it might be late for some sectors of this, rally, we would say, I really like midstream energy specifically. So just make sure you understand the risk and the time horizon before you, make a mistake that is very, very difficult to recover from. And that's the thing about finance, friends. This isn't like playing Monopoly. In finance, if you make a bad decision, these things can take you years to recover from. If you take a bad loan, or you make a bad investment, or you buy a house and it doesn't go, or an investment property and it doesn't go well, that thing can be catastrophic to your long-term financial plan. So it is important to do research upon research upon research, and then do diligence and all of that stuff. So, Alright friends, so on today's breakdown, I want to talk about my favorite strategy in finance. There's no need to make, financial literacy overly complicated. This is the secret sauce right here that Warren Buffett and everybody lives by. It's called dollar cost averaging. This is how you buy low and sell high. You don't try to do it by timing the market. You don't try to do it by day trading or anything like that. Alright, so this is how you buy low and sell high. You ready? Okay, so dollar cost averaging. All it means is that you're buying, it's basically a systematic process of investing, right? And it's a routine basis, whether it's weekly, monthly, quarterly, annually, whatever your cadence is, it's essentially a routine, right? A cadence of you investing into the market. You're kind of phasing out the idea of what the price of that investment is actually doing in that moment in time, because you're going to make that trade regardless, right? So, I think most people benefit from dollar cost averaging from their weekly paycheck, or their every 2 weeks, bi-weekly paycheck. Every 2 weeks you get paid, every month you get paid, every week you get paid. A portion of that should go directly into investments, whether stock, bonds, or real estate, whatever it is, that's a different story. But a portion of your money every week should go right into an account that dollar cost averages over the long term. And what happens is every week or month or every 2 weeks, you're buying investments, right? Whether stock, bonds, or real estate, doesn't matter. This works across the board. And you're buying these investments, and 1 week you buy low, the next week you buy high, the next week you buy low, the next week you buy high. But over the long term, when you zoom out and you do the math, you'll see that you're likely lowering your cost basis, using finance words here, right? That you're lowering your, cost of entry point, so to say, because, when you're buying it at a fluctuation over time, on average, you're buying it lower than what it trades at any particular moment in time. So you could just do the math, back of the napkin math, right? Let's say you buy ABC stock, whatever company it is, right? At, 1, 2, 3, ABC, XYZ, whatever stock you want to buy. and you do it for 4 weeks, and 1 week is $5, the next week is $8, the next week is $5, the next week is $9. Do the math. What's your average cost per basis there? It's not $9, it's not $8, it's not $5, it's somewhere in between. So that's the concept of dollar cost averaging. It's kind of just fading out the actual price action and focusing on the systematic process of deploying capital, right? Of making investments, whether stock, bonds, or real estate, that's a different conversation. But the idea here is that one time you're buying an investment at a certain price, the next time you're buying it at a higher price or lower price, but over time, you'll see that you would have paid a lower price per unit, right? A lower price per stock than what you would have had you just deployed it all at once at any moment in time. So this is why I'm a huge fan of dollar cost averaging. 99% of financial advisors would tell you this works for the everyday person. I don't know why we make financial literacy any harder than it has to be. Shout out. All right, this is one of the most important terms in real estate. It's called cap rates or capitalization rates. Let's not make financial literacy any harder than it has to be. Friends, if you're looking at an investment property, if you're looking at a real estate deal, one of the first questions you should be asking is, what's the cap rates? What's the capitalization rates? AKA, what can an investor assume based off the information you're providing? What can an investor assume to get on a, like in terms of profitability or return on investment on an annual basis, right? So friends, let's pretend you're buying an investment property and it's about $100 and you get $10 a year in profitability. In this simple example, your cap rate is 10%. It's literally that simple. Now, there are some ways to, get cute with the numbers and make the numbers dance, so to say. So any real estate investor will double click on that. You're not going to take it for the face value. But, for our conversation in terms of just good faith investing, if you see something that says cap rate 10%, assume you should probably make about 10% of a year in profitability. Capitalization rate, friends. Cap rate. It's almost that simple. In terms of policy and economics, let's continue the conversation on real estate. Let's talk about why home prices are so high. From a supply and demand aspect, depending on what report you read, there's a shortage of about 3 to 6 million homes. Some reports say even more. There's a shortage of about 3 to 6 million units in America just to cover today's demand, so to say. So because there's a shortage on the units and that demand is there from a supply and demand aspect, there's a huge imbalance, which is driving home prices up. Leading up to the 2007, 8, and 9 great financial crisis, we saw a boom in home construction. But we all know that the housing market, sort of collapsed during that time period. And, housing construction never really made it back to its grand financial crisis levels. So that, along with immigration, along with just inflation in the last few years, has led to this huge unaffordability problem that we're having. And that has put upward pressure on homes, making homes even more expensive. Homes are, depending on what report you read and depending on what subsector of real estate you're considering, homes are basically 50% more expensive than what they were pre-COVID. Think about how much more they're expensive today when compared to 2007, 8, and 9. A couple of decades ago, the average first-time home buyer was 30. Today, the average first-time home buyer is 40. It's not getting any easier. So from a supply and demand aspect, what can we do? Well, the demand doesn't seem to be softening up, right? People are living longer, they're healthier, unemployment has been pretty low for the last couple of years. There is a need for housing, obviously. And on the other side, construction costs have gone up, right? Labor has gone up. The commodities to build homes have gone up since COVID, right? Inflation, supply chain shocks, all that, tariffs, all that stuff, right? So the labor, super duper expensive. The cost of the material, super duper expensive. And then you think about the political environment, right? And this is why we're calling it policy and economics, right? Because it's incredibly difficult for new homes to come online. There's all sorts of permits, town halls, and of course there's this thing called NIMBA, not in my backyard. People do not want new homes being built, right? Because they know that'll lower their home prices. They definitely don't want affordable housing being built in their neighborhood. And my neighborhood, they claim it changes the outlook of the neighborhood. AKA, we don't want poor people here. And it's a damn shame because everybody needs a place to live. So when you think about all these hurdles that developers have to overcome just to, create housing, it's that's why that's why there's not that much supply, but the demand continues. So long term, there's upside potential in investing in real estate, obviously, because the supply doesn't seem to be changing, while the demand is holding steady. But man, for the people that need housing, it remains incredibly difficult. So what do I personally think, and this is my opinion, what do I personally think is required to help bring housing costs down? Certainly not price controls, as I teach in economics. Certainly not, rent controls. Certainly not rent ceilings or anything like that. Because as a real estate investor, what incentive do I have to invest in your community if I know rents are locked at a certain premium? What incentive do I have to renovate my property if I know I can't get the premium rents? What incentive do real estate investors have to invest in a place like New York City, where it's just so much red tape to create a profit that you can redeploy that money in, like, Florida or Texas, where there's practically no laws, and get a return on your investment right away? Somewhere in between, there has to be a balance. So what do I think personally? What's my opinion here? To solve that problem, well, we need more supply. And in order to get more supply, we need the government to play nice. And that's not just on a federal level. We need the states to play nice. We need the municipalities to play nice. And then we need the local communities to play nice as well. Because collectively, we need more supply. And until there's more supply, or at least demand softens up, home prices are going to remain artificially high. So, that's really the only, as an economist, that's the only way to fix this problem. It's a supply side problem. It's not a demand side problem. And because it's a supply side problem, you don't want to penalize the people who are bringing supply online. You don't want to penalize the investors, developers, contractors, and that whole ecosystem. So what the answer is, I don't know, but my humble opinion, it's a supply side problem. We need more supply. We need government intervention. We need incentives to incentivize the development of more supply coming online to satisfy the current demand, to help alleviate some of those high home prices. So from an economics perspective, as a capitalist, we need that incentive to deploy capital. Otherwise, we're not going to deploy capital into the areas that need it most. And this is why housing in New York City remains incredibly expensive, because you have all these rent control units, you have all this red tape that the local governments put in place. Their justification is that they're protecting the consumer, they're protecting the tenant and whatnot, and I understand that too. Somewhere there has to be a balance, but the important thing is to have a balance, not an imbalance. And because you have all these units that are rent controlled or just not being occupied, frankly, that's less units in the marketplace, which is driving higher prices up. So when they're talking about the neighborhood is changing, that Harlem is changing, or Washington Heights is changing, or blah, 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 South Bronx is changing, it's because we need more supply. So I'm actually a fan of, and I'm in the camp of, bring on more supply. Keeping it true to its roots is by bringing on more supplies, by inviting the new inventory, not turning it away. So, that's just my humble opinion on today's policy and economics. We spoke about a lot today. We spoke about, dollar cost average, which works in both stocks, bonds, and real estate. We spoke about cap rates, which is important, right? That's one of the most important terms in real estate. Then on policy and economic side, we talk about what's driving home prices up. So, at the end of the day, when you think about these concepts from an investor perspective or an economics perspective, it kind of removes the noise of personally being engaged. I too identify as broke. I too identify as, housing is too damn expensive, and I'm getting my ass kicked by life too. But I truly a believer that the only way to drive some of these prices down in all forms of commodities, whether we're talking housing, whether we're talking cars, whether we're talking anything else, the only way to bring prices down of anything is by bringing on more supply or killing demand. And in this case, we don't want demand deterioration. So, nor do we suspect that there will be demand deterioration when it comes to this housing balance. So plan accordingly, friends. So with that, hope you enjoyed today's episode of Invested in Us. We're going to ask that you follow us across all social media platforms, whether it's our YouTube channel. You can follow NJK Partners. It's at NJK Partners. You can follow me directly at Kevin Nunez NJK. Visit our website, njkpartners.com. Sign up to this, weekly newsletter. All that fun stuff. Call us, text us, fax us, whatever you need. We're happy to help, friends. So with that, thank you again for watching Invested in Us, where we explain money how it should have been explained to us. I'm your founder, Kevin Nunez, and I'm looking forward to another week next week, y'all. Peace.